Hello and welcome to the Estate Planning Toolbox. Thanks for taking some time out of your day to check out everything we have going on here. My name is John Connor and I am an attorney in the Trust and Estates Group of Graves Doherty here in Ann Moody, a law firm located in downtown Austin, Texas. This podcast is a client-focused podcast covering various estate planning topics, including wills and trusts, powers of attorney, corporate entities such as LLCs and limited partnerships, probate administration, and everything in between. Thanks very much for stopping by. Hello everyone and welcome back to the Estate Planning Toolbox. Today we're going to be starting our series on the many ways to make a gift, and we're going to be taking a look at direct gifts and also using trust to make gifts. Before we get started though, here's today's movie quote of the day.
Blast this Christmas music! It's joyful and triumphant.
Once again, that is clearly from a Christmas movie and a fairly famous one with Jim Carrey in it. That's your biggest hint. And of course, if you don't know what movie that's from, stick around until the end of the podcast and find out the answer. So taking a look first at what we're going to be talking about today, we're going to be talking about one, direct gifts, which are gifts obviously made directly to a beneficiary, but we're also going to be talking about some direct gifts that can be made on behalf of a beneficiary. Then we're going to transition and talk a little bit about trusts. We'll be talking about crummy trusts and generation-skipping trusts. So starting with direct gifts, let's talk a little bit about gifts that are paid directly to a beneficiary. Pretty obviously, that is simply giving an asset, maybe it's cash, could be land, could really be anything, and you give it directly to the beneficiary. You will, of course, be able to make use of the annual exclusion amount. That, again, for 2018 is $15,000, and for 2019, that will also be $15,000. Keep in mind that if you make a gift on 12/31 and then wake up on January 1st, 2019 and want to make another gift, you can do so. You can make a $15,000 gift on December 31st and another $15,000 gift on January 1st, and will not have to worry at all about having to pay any gift tax or file a gift tax return. Of course, if the asset that you give to a beneficiary has a value in excess of the $15,000 annual exclusion, then you will be using up some of your lifetime exemption amount, which again we talked about for 2018 is $11.18 million per person, and in 2019 will be going up to $11.4 million per person. So again, if you make a gift of an asset that is worth more than $15,000, you will be reducing your lifetime exemption amount. Doesn't necessarily mean you'll owe any gift tax, but if you do make that gift in excess of the $15,000 annual exclusion, you will need to file a gift tax return showing that you've made that gift and showing a reduction in your lifetime exemption amount. Do keep in mind that essentially that any gifts between spouses are not subject to gift taxes whatsoever. That could be a gift of $1,000, it could be a gift of $1 billion. Generally speaking, as long as gifts are between spouses, there is no gift tax. Keep in mind there are some special rules for spouses that are not U.S. citizens, but that's really a different topic for a different day. Now you might be thinking to yourself, well, what if I don't want to give that asset, that gift directly to a beneficiary? May have any number of reasons for doing that, but one way that you can still make a gift to a beneficiary is really by making that gift on behalf of a beneficiary. The Internal Revenue Code in section 2503 subsection E basically says that any amounts that are paid directly to a medical provider or an educational institution are not subject to a gift tax. More importantly, they do not apply towards the annual exclusion amount. So say that you have a child that you've already written a $15,000 check to, and say that child is also in college. So instead of making further gifts to that child, let's just say of cash, and therefore requiring you to file a gift tax return, you can make payments directly to the educational institution and not have to worry at all about that annual exclusion amount. Do keep in mind that the amounts paid directly to a medical provider or an educational institution, there are some rules to keep in mind that I really don't want to get into today because there's a lot of them. But generally speaking, you need to pay it directly to the medical provider or the educational institution. You cannot use the child or a trust really as a go-between. You need to make the payment directly to them in order to make use of this ability to pay for medical expenses or educational expenses on behalf of a beneficiary without having to worry about the annual exclusion or the lifetime exemption amount. Alternatively, Alternatively, someone might be thinking that if they don't want to make a gift directly to a beneficiary, they may want to put that gift inside of a trust. And that's actually a very useful tool. You can put the asset inside the trust, let the trustee manage it, and let that asset be there for the benefit of the beneficiary without giving them immediate 100% access to it. However, we do need to be careful when making a gift to a trust. Generally speaking, we want to use that annual exclusion, and we want to use it to our benefit as much as we can. Gifts in trust, however, are not automatically able to use the annual exclusion amount, and that's because to make use of the annual exclusion, you have to give the beneficiary an immediate right to use the gift. Obviously, when you've made a direct gift to a beneficiary just by perhaps writing them a check, they have the immediate right to access that gift. However, when you put an asset in trust, the law basically says that they do not necessarily have that right to immediately access that gift, meaning you do not get to use the annual exclusion and immediately jump to using up some of your lifetime exemption and having to file a gift tax return. However, in steps the crummy trust, which really isn't a very good name for a trust. Obviously the word crummy sounds like something that's not very good or very useful. Really, it's just named after a famous case, Crummy et al. Versus Commissioner of Internal Revenue. Here's the site for that case if you really do want to go read it. It's actually a pretty fascinating case, but the crux is this. By using the language or something similar to the language that was used in the crummy case, you can ensure that the gifts made to the trust will qualify for the annual exclusion. What the crummy trust language does is gives the beneficiary certain withdrawal rights, and those withdrawal rights result in the beneficiary having a present interest in the trust. And it's that present interest that lets the donor apply the annual exclusion amount to that gift. The crummy trust provisions are a really big benefit to the trust because now we can transfer assets up to the annual exclusion amount without having to worry about the gift taxes or having to file a gift tax return. And the assets that we've transferred to the trust are now, they're available to the beneficiaries for their benefit to be used by the trustee to pay to the beneficiaries for something like health, education, maintenance, and support. And the assets in the trust can continue to grow and appreciate in value. And that growth and appreciation is effectively shielded from gift tax as well as estate tax. Now, in terms of a crummy trust, the IRS has essentially said it looks for 4 things to determine whether the withdrawal right is sufficient to allow the annual exclusion amount to be used for amounts transferred to the trust. 1, the trust needs to be required to give the beneficiary a reasonable notice in which to exercise a withdrawal right. You can't just put the withdrawal right in the trust and never tell the beneficiary. The beneficiary needs to be told they have the withdrawal right. Number 2, the beneficiary must be given adequate time following notice in which to exercise their withdrawal right. You can't just give them notice, give them 24 hours or 20 minutes. You actually have to give them some time, 2 weeks, 30 days. Usually 30 days is a good mark in which to exercise their withdrawal right. Upon exercising the withdrawal right, the beneficiary will need to have the immediate and unrestricted right to the amount that has been contributed to the trust. Essentially, this means that if the beneficiary exercises their withdrawal right, they have to have the immediate and unrestricted right to actually get those funds. Finally, there needs to be no understanding or agreement expressed or implied that the withdrawal right not be exercised. Meaning you can't go into it telling the beneficiaries, hey, I'm going to give you this withdrawal right, but you're not going to be able to use it. If it's in the trust and they exercise it, technically they have the right to withdraw it, and you cannot have an agreement expressed or implied with the beneficiary that even though that withdrawal right is in there, the beneficiary is not going to use it. So now let's talk about generation skipping trusts. As we've talked about in prior podcasts, the generation skipping transfer tax applies to transfers to beneficiaries that are more than one generation below your own, which includes something like grandchildren, great-grandchildren, or anyone who is more than 37 and a half years below your own. So there's no requirement in a generation skipping trust that the beneficiary be a grandchild or even a family member. As long as they are someone more than one generation below your own or someone who is more than 37 and a half years younger than you, then they are a quote-unquote skip person and can be a beneficiary of a generation skipping trust. Very often when we see these trusts, they do involve a family and they typically involve grandchildren because the idea is that you'll skip the grantors children or the person that is only one generation below theirs and go straight to the grandchildren or great-grandchildren or someone who's more than one generation below their own. The idea being you're going to skip the estate taxes that might have otherwise been applied at the child or first generation's death and go straight down to that second or lower generation. Do keep in mind, and this is very important, that just because you're skipping that first generation or children does not mean that you can't provide them with some benefit. They can still be current income beneficiaries of the trust. You're also just you're not giving them anything when you die or when they die, but you can give them an immediate right to receive income distributions from the trust. When setting up a generation skipping trust, you really want to keep an eye on your exemption amounts. As we discussed, the generation skipping transfer tax exemption amount for 2018 is $11.18 million per person and is going up to $11.4 million per person in 2019. In the case of generation skipping trusts, and really in the case of generation skipping transfers at all, we want to be sure that when we make those gifts, that those gifts receive an inclusion ratio of 0. The inclusion ratio is a fancy mathematical way that the IRS determines how much generation skipping transfer tax to apply, and typically, to the best of our abilities, we want to have gifts either have an inclusion ratio of 0, meaning generation skipping transfer tax will not apply because of the exemption, or when the exemption gets used up, that the generation skipping transfers either to trust or outright have an inclusion ratio of 1, meaning it's entirely subject to the generation skipping transfer tax. That being said, you really want to watch your exemptions because you want those generation skipping trusts to have an exemption amount of 0 and not some funny fraction subjecting future distributions to generation skipping transfer taxes. Just like crummy trusts, once the generation skipping trust has been funded and the exemption has been allocated, future appreciation is essentially allocated to trust beneficiaries, pulling it out of the estate of the donor and the donor's children, which is a very big financial benefit in tax savings to the trust beneficiaries, those skip persons. So in summary, there's a lot of ways that you can make gifts, especially direct gifts to beneficiaries without having to pay gift tax. Number one, make use of the annual exclusion. You have $15,000 worth of assets that you can give to every single person on earth. So if you have 4 children, that's essentially $60,000, $15,000 to each of them that you can pass free of gift tax and without having to worry about filing a gift tax return. Also, as we talked about, you can make payments directly to medical providers and or educational institutions. You make a payment directly to them. Not only is it not subject to the gift tax, it doesn't even count against the annual exclusion gifts. So that's a very big, powerful gifting tool that donors can make use of. Trust can also be a big benefit, but you want to be sure that you include those necessary withdrawal rights, those crummy powers, to ensure that you can make use of the annual exclusion amount and not unnecessarily cut into your lifetime exemption amount. And you'll also want to make sure you watch your exemptions, especially when you're using a generation skipping transfer trust. All this said, I want everyone to understand that what I'm talking about here is gift tax consequences for gifts and trusts. I'm not really talking about any income tax consequences that might come from any of this. If you have those types of questions, those are really for another podcast and really a good discussion to have with your CPA. So that's it for today and for part 1 of the many ways to make a gift. Very 30,000-foot view on direct gifts and gifts in trust. In our next episode, we will be talking about making gifts to charity, so do be sure to check that out soon. But before we go, here is the answer to today's movie quote of the day, and it is from Dr. Seuss's How the Grinch Stole Christmas.
Blast this Christmas music! It's joyful and triumphant.
Well, thank y'all again very much for stopping by. Of course, if you have any questions or topics that you would like discussed on the estate planning toolbox, here is my contact information. Do not hesitate to reach out via email or to give me a phone call. And of course, be sure to check in very soon for our next podcast when we will be discussing gifts to charities. Thank y'all again for stopping by.